In this video, we're going to talk about how I trade my son's account. You can do this too. If you're a grandparent or maybe you're a parent, you're thinking about how you're going to help your kids generate cash flow for college or maybe just moving forward in life. If you follow what I'm doing here, you can absolutely do this. And if you look on screen right now, you can absolutely join me, follow what I'm doing, and maybe you'll be able to help your kids with their college funds or just living life, getting ahead in life. You know, we sell premium all the time. My kids personally have benefited over the years, many times over. That's what we do. We use the golden goose of cash flow. That is the covered call writing and cash secure put selling. We lay the golden egg, which is the premium. We take that premium and buy a dividend paying fund. That would be your passive income. Then we drip invest those so they have passive forward income for life. Hey, look, stick around. I know you're going to like this one. Hey, welcome back, everyone. Let's talk about my recent trade for my kids account. This is my oldest son. Last week, May 19th, we went ahead and put on what seems to be about a 1 week cash secure put. Now, the reason I'm showing you this video is because of the strike price and how I picked it. How did I determine the strike price? A lot of people ask me about that. How do I know where to pick strike prices? A lot of times I use the expected stock move calculator, particularly when I'm down on a trade and I'm going to write an out of the money strike that is below my cost basis. Now that's scary, right? Because if the stock were to move higher, we get any sort of news where the ETF or stock moves considerably higher, we could have our shares taken away at a loss. So we want to use the expected stock move calculator because it gives us a little bit of a range for which the stock could trade during the time frame. With LABU, he's not at risk at that. He's actually doing a put. So the real question is, where do we pick the strike price? Picking strike prices for cash secure puts using leveraged ETFs really has to do with two trades. We always talk about putting on that very first trade, and then if we're assigned the shares, we're going to go ahead and write a covered call. And what we want to do is get a feel for where the stock's trading, and then if we were assigned, if we can get off a second covered call trade. Now, we're talking about LABU, and when I put this trade on, I went ahead and selected the 48 strike. Now, when we do this, it's trading for about 51. And the reason I decided to pick the 48 strike, because when it was trading for 50, well, I'm thinking to myself, if this thing falls some $2, we're going to find ourselves at the 48 strike. Lately, it's found support at 46. So notice, we're putting on a cash secure put when it's trading at 50. We're getting some $2 in downside protection. And if we're assigned the shares, then even if it were to fall to 46, we could still get off. In a worst case scenario, if we can't use weeklies, we could do a 30-day covered call and get about 6% using the cost basis of 48. Now let's take a look when I did this. We did this on May 19th. So let's back up and take a look at May 19th. It's right here. And it has rallied off of that 44 number to where now it's trading right around 50. So I'm thinking if it's going to peel back, it's going to find itself at the top of this candle right here on the 14th. And you can see that's around 48. I'm thinking if I write a short window cash secure put and this thing pulls back, it's going to come back to 48. And that is okay because if it were to bounce off of 48 and move higher, again, I can write an at the money 48 and have two premiums in my pocket, probably averaging about 6% in a 2-week window. So we're always thinking about two trades here. When it is trading on the 19th in and around 51, well, we put on that 48 cash secure put strike. Now we put it on and it's going to be for about a week. And sure enough, this thing moves a little bit higher and then it starts to drift down. It's not even coming close to testing this top line right here on May 14th. Now, if it did, again, we're not going to be worried. We have the mindset that this thing on its worst day would find itself at 44.68. And if you do the math, we can get off a covered call for the 48 strike, even with it trading at 44.68, and pick up about 5 to 6% in premium getting out at our cost basis. We will have made two premiums, the first one being some 3.2%, and the second one, because we're getting that off for a little bit longer dated covered call, probably get about 5% there. This trade might be about 4 weeks. This is all hypothetical because we haven't been assigned the shares. We get 8% in about 4 weeks. And we're using its trading range. So we go back to the Keltner channel and we take a look at the Keltner channel. And we haven't talked about this in a little bit, but what we do is we break the Keltner channel up in pieces. Everybody looks at the top side and the bottom side and the mid. Well, once a stock is in and around its mid, we need to break it up so we have new top line, new bottom line, and the mid acts as the center. So when on the 19th it's rallying higher, well, I'm going to use that midline as my support. And as it breaks through, you can see now we move forward. The stock is pulled back and it basically traded in and around 48, right where I picked. Remember May 14th, I said it's going to come back to the top of the candle. Sure enough, it did that, popped higher. We were not assigned the shares. He ends up making all the premium and he's out of the trade, making 3.2% cash on cash, $310. That's why we do that trade. We do the trade because we have a tradable bottom. We looked at the Keltner channel and we realized where it could be trading in the Keltner channel, and we're going to go for it. Now, in this market, I always want downside protection. This market will have this stock go from 44x to 54x back to 44x real quick. So when we place on a trade and we're putting new money at risk, and remember, we're getting close to July 9th. That's when the tariffs go back on. So we want to keep these trades short term and we want to give ourselves downside. So that's what I did in this trade. I gave myself downside as it's moving higher. And if it were to pull back over the next week, then hopefully that move higher gave us the cushion. So when it did come back, and you could see it did come back, well, the selling got exhausted and then it moved higher. We weren't assigned the shares. Again, Keltner channel is very important because it shows a stock's trading range. This is Mr. Obvious. There's really no settings. We're just looking to trade the range. Now, what did we do with all that premium profit of $310? Well, of course, we went ahead and bought 13 shares of SPYT. This is a 30-day high-yielding dividend payer. Pays about 33 cents a month. So we don't get much NAV erosion. He can accumulate a lot of shares when we're doing trades where he makes $310. I think this thing's trading for about $17. That's what we're going to do. Now he has long-term passive income. And we have this drip invested. So what's happening is it is buying shares on top of shares. And this profit cycle continues. And look, he's young. He's going to be able to have a mountain of dividend-paying stocks. Why? Because we write covered calls to generate cash flow. He doesn't have to take to the 9 to 5. All he has to do is sell premium. He generates the golden egg of cash flow. That is the covered call and cash secure put premium. He takes that and buys the dividend-paying stock. This is your passive income. We go from the trade mindset to the wealth mindset real quick because we take profits, we buy cash producing assets. And of course, we went ahead and paid the tax man. So he's not going to have any tax implications here outside of paying the tax man. And that's what he did. We went ahead and bought XDTE. That is my tax bucket ETF. This thing is going to pay me a dividend. It has a 70% return of capital, which means for every dollar we drop in here, 70 cents is return of capital, 30 cents is going to be taxed. And what's going to be taxed on 30 cents? He might owe 3 pennies for every dollar. This is what we do. This is the mindset. We use the golden goose of cash flow, writing covered calls, selling cash secure puts. We take that profit, we buy a dividend paying fund that pays us passively, and we drip invest it, so we keep buying more and more shares, making more and more dividends. Then we pay the tax man. And when we pay the tax man, we buy XDTE, which is going to pay us a dividend. And that dividend is going to be 70% return of capital. So that means we're only being taxed on 30 cents, or about 3 cents on every dollar. Hey, look, be safe, be healthy, most important, be lucky. Until next time, may all your covered calls be profitable.